Thanks for tuning into the Finance News Network. I'm Jessica Amir at the offices of Ausbil with Ausbil's Global Resource Fund portfolio managers, Luke Smith and James Stewart. Gentlemen, welcome to the network.
Thank you. Thank you.
So first up, could you just give us an introduction to the fund?
The Ausbil Global Resources Fund invests in natural resources companies globally. We use the same proven approach that's been used by Ausbil for many years, which includes a top-down macro and commodity analysis combined with bottom-up valuation basis on the companies that we look at. We attempt to generate positive returns through the cycle using our long-short investment approach.
Thanks, James. Now over to you, Luke. We've seen commodities do quite well. In fact, the iron ore price is at a 5-year high. What's fueled this and how is this benefiting global resources?
There's two main factors that have driven the strength in iron ore prices this year. Firstly, demand, and then secondly, issues around supply. In terms of demand, Chinese steel production has been growing at 10% year on year. The property market has been primarily the factor that's driven that. And then secondly, in terms of supply, two key exporting nations in Brazil and Australia continue to have issues, firstly with Brazil and the tailings dam failure earlier this year, and then secondly in Australia with the cyclones and issues at both mines and processing facilities. As a result, we're seeing strength in iron ore prices, and that's fed into strength of earnings, cash flow, and will likely also result in strong capital management programs by the key producing companies.
Thanks, Luke. Now back to you, James. Just tell us about the investment objectives and the style of the fund.
So our objective is to generate absolute returns through the cycle. The universe we look at is global natural resources, which includes hard commodities, so things like iron ore, gold, copper, nickel, etc. Soft commodities, so agriculture, forestry, chemicals, and also any directly associated services. We do use a long-short approach to investing with the goal of managing risk within our portfolio and generating risk-controlled outperformance through the cycle.
Great. And what are your largest exposures in the fund?
Sure. So as Luke mentioned, we are positive on iron ore as a commodity. That's our largest sector exposure at the moment. In terms of companies that we like locally, Rio Tinto and Fortescue Metals are amongst our largest exposures. And in terms of a global basis, we also own Champion Iron, which is Canadian listed, and the Labrador Iron Ore Royalty Company as well, which is listed in Canada.
Great. So now can you talk about performance?
So pleasingly, last year we generated a return of 8.9% after all fees. This was during a very volatile year when the MSCI Global Select Natural Resources Index was down 2.2% during the year.
Thanks, James. Now back to you, Luke. The sector, resources and commodities itself, is quite volatile and cyclical. How should investors navigate through this?
I guess the key risk that's impacting the sector at the moment is trade uncertainty, with a range of the trade wars that are ongoing, impacting on global growth more broadly. And as a result, we're taking shorter-term tactical trading opportunities where we see valuations appropriate. But clearly, that risk management framework that we employ to try and navigate through trade wars is the key factor that we're focusing on.
And just lastly, before we let you go, what's the outlook for the second half?
Yes, the second half, like I highlighted, is going to be dominated by trade uncertainty. In terms of our positioning, we're looking to ensure that we focus on sectors that are less exposed to global trade. And as a result, we're focusing in on areas where China's likely to stimulate, namely steel-intensive raw materials in iron ore and met coal. And then secondly, on a shorter-term basis, we're looking at tactical opportunities from a valuation standpoint, such as in copper and oil, where we see opportunities, but at the same time managing risk appropriately.
Luke Smith, James Stewart, thank you so much for your insights.
Thank you.